Thank you for joining us today. My name is Anthony Booth. I work for Pursuit in Business Development, covering the state of Connecticut, and I'm joined today by my close colleague, Dave Hanold. Dave has been with Pursuit for 14 years and serves as Senior Vice President and Chief Lending Officer, which means he makes most of the credit decisions for loans less than $100,000. Today, we will be discussing business distributions and how lenders like Pursuit view distributions when considering business applicants for loans. And so, fortunately, Dave, I consider you the expert on all things lending, and particularly on the subject of distributions and how we look at them as a lender, considering you're making those decisions. So maybe we start with kind of some of the basics. What are business distributions?
Sure. A business distribution is another form of owner compensation. An owner can pay themselves in a few common ways, but the most common are owner salary, a very regular scheduled biweekly or monthly transfer, same way you pay an employee. And you go get a W-2 at the end of the year and you're a formal salaried employee of your own business. That's one way. The second way is via distributions. In our experience, distributions tend to be more common for businesses that have irregular cash flow or are not yet very long tenured. Maybe they're not yet at 2, 3, 4 years of operation, and their cash in their bank account is not as predictable as a longer standing business. So they take money out with less planning, perhaps, because you can't plan on when cash is in the bank account. So maybe it's withdrawal every 1 or 3 weeks or every couple months. At the end of the year, however, a lender like us is going to look at it as salary and a distribution as essentially the same. Money that has left the business to serve as owner compensation to cover that owner's essential needs, which of course are important. So that's what distributions are. It's a way of paying an owner, and they're just recorded differently. So when you think about a business's financial statements, you've got revenue, then you've got your cost of goods, you've got various operating expenses like rent and insurance and utilities. If you put yourself on salary, owner salary is going to be there as an operating expense, and therefore it will reduce your profit, your bottom line, at the end of the year. If you don't pay yourself a salary and instead you record your compensation as a distribution, your profit might appear higher, but you're compensating yourself simply directly out of your earnings after your expenses are kind of calculated.
Okay.
We here as a lender identify both ways of compensation. And in either scenario, whether an owner pays himself via salary or via distributions, sometimes called dividends or owner draws or owner withdrawals, we cannot consider either of those forms of compensation as cash flow that's available to service a business debt payment to us. So if a business makes a net income of $100,000, but that business owner takes distributions of $105,000, distributions exceed profits, we are more likely to come to the conclusion that there is inadequate cash flow available at the end of the year to make the annual loan payment required to us. And most lenders look at it the exact same way. So another way of putting it is distributions are a balance sheet withdrawal, whereas salary is a profit loss expense. But to us as a lender, they impact the repayment ability the exact same.
So if I understand, whether it's a salary or a distribution, although with distributions, I'm going to see, let's say, my net income higher on a tax return, or I'm going to see that net profit higher in my profit and loss statement or my bottom line. Regardless, it's coming out of what a lender would consider is the amount of money I have available to pay for debt. Does that sound right?
Absolutely. And it's a good time to talk about maybe the most common question that we get in general, which is, what are you at Pursuit looking for? What is a small business lender looking for to assess approval or declination? And the answer is always, the most common answer is cash flow. That's the number one most important thing that we're looking for. Cash flow as a small business lender is what's left over after all expenses and debt obligations that already exist are accounted for. So
and distributions are included in that.
Distributions end up getting included one way or another. One way or another, they negatively impact the assessment of cash flow available to service a loan. So if a business owner is thinking about how much they make in revenue, then they're thinking about all their expenses, and then they're going to end up with earnings. Lenders have a cash flow assessment called EBITDA, and the most important input is earnings or profit or your bottom line. If you take a salary, that will reduce your earnings. If you don't take a salary, your earnings might appear higher. If distributions are taken, however, they are then debited by any small business lender looking at cash flow as a debit, as a subtraction from your earnings. That reduces the amount of annual cash flow that a lender will see as available to service a small business loan. So how does that work in practice? If a small business has $500,000 in revenue, and after their cost of goods sold, their cost of supplies, after maybe an owner's salary, after rent and payroll to other employees and insurance and utilities, let's say their net income is $100,000 and their distributions after those profits are recorded, after those earnings are calculated, is $50,000. That would leave $50,000 available to service loan payments, whether there's existing loans on the books or they're asking for a new loan from us. And in that assessment, there's some cash flow after all expenses and after all distributions are accounted for.
So, sounds like it's a hard debit, right? So that, business owners just need to understand that distributions are going to take away from their cash flow that can be considered for paying a loan. But like, I know certain situations that we've run into, that we've looked at, different types of financials for businesses. Some business owners are kind of living out of their business financials, right? So they have one checking account for everything. That's their business account, and they're using that to pay their rent. They're using that to pay their personal expenses. And so, they're not, let's say, taking regular or scheduled distributions. I've heard from many accountants that they recommend that that's exactly what they should do. So my question to you is like, is that something you would recommend as well? And where do you see that kind of organization benefiting business owners when, let's say, they're separating their business and personal expenses, or if they're going to take distributions as opposed to salary, that they're doing it regularly, let's say taking $2,000 a month and then moving over to their personal accounts, right? And separating those expenses versus scenarios where just realistically, some business owners are or continue to live out of their business accounts.
Sure. We generally leave how a business owner records things up to them and their accountant, but in our experience, it's definitely way messier when personal expenses come directly out of a business bank account. You're creating more work for your accountant to separate out, oh, this trip to the movies was personal and this trip to a supplier was a business-related travel expense. More time for your accountant to go and separate those different transactions and categorize them into line items in your financial statements. It also reduces a small business owner's ability to know their own business and whether they are profitable. If you are planning every month to move $3,000 or $5,000 or $10,000 from your business bank account to your personal bank account, and all of your personal expenses come out of your personal account, you've got predictability there. And after those predicted, recurring, and unchanging transfers, whether they're salary every 2 weeks or whether they're a distribution at the end of every month, if you see your cash growing, that's a good indication that you're profitable. It's a good indication that you are keeping more in your business than is leaving the business. Lenders end up assessing for all that as well. If we see a small business owner that doesn't have planned recurring transfers, again, it could be salary, it could be distributions, but either way, when we see the cash being either pulled out as soon as it comes in or spent as soon as it comes in, that doesn't look like they're financially planning as well as we would hope. And it might just reduce the cash on hand month after month after month. When a stronger business cash flow statement, a stronger business balance sheet, a stronger business P&L will retain as much cash in the business as possible. It's up to every small business owner to assess what they need to cover their own obligations. Someone that lives in a lower cost of living region is probably not going to require the same owner compensation, whether it's salary distributions, as a small business owner that lives in Manhattan. If you live in a certain spot, you may have lower obligations. We don't pass judgment on how much a business owner needs to cover their expenses. We pass judgment on the bills are what they are. Are they going to get paid? How are they going to get paid? So once a business owner has assessed, okay, I used to make $50,000 or $75,000 at my salaried position at my prior employer. I'm going to start a business now, and I'm going to plan to pay myself $75,000 by year 2. That'll be the same salary as I made before. I started my business. That's what I need to cover my rent and my utilities and my health insurance and all the things that I have to cover in my household. Let's say that that's accounted for as owner salary. It's planned. It ends up being in a bi-weekly payment. And then the business is profitable after year 2. That's great. If the business owner then starts to take distributions on top of the salary that they already have been paying themselves, that reduces the cash flow that we as a lender assess as being available to service a loan. It reduces the cash on hand in case of something unexpected. Costs might go up. Salary laws might change. Insurance laws might change. Cost of goods, where you're sourcing stuff. Things are going to happen. You might have a bad season. There might be construction outside your location. The more cash a business owner has on hand, the more resilient they are to unexpected events and shocks and temporary shortfalls. So when we as a lender are assessing not just does a business owner have profit, do they have earnings, and do they restrict distributions to be less than their earnings, which is what we generally recommend. The impact in the long term is planning for the worst case scenario. It's our job to plan for what might happen in the 5 to 10 year period. And the more a business owner is able to build up their own working capital cushion, their own cash reserve, the stronger that looks in terms of long-term repayment ability.
So if I understand and kind of summarize some of the things that you said correctly, we're not necessarily recommending specifically for business owners to take salary or not to take salary, or to take distributions or not to. But in general, the more organized and the better that they plan for these sorts of things, the benefits are huge. It sounds like they're going to have a better understanding of their bottom line. They're going to have a better understanding of how much profit they're going to make. It's going to make their lives easier with their accountants, right? And save them time and money in accounting expenses. But then also as it relates to how they grow their business and being able to see, is this business financially viable? Are they able to continue to pay their bills? Are they able to afford to take on debt? Those things are going to be more apparent, not just to us as lenders, to them as business owners as well. Does that sound right?
Yeah. We want small business owners to be successful with or without our loan, right? And part of being successful is building up a business that has value, that has profit. Small business owners might, benefit from thinking about what's my exit strategy. They might want to be purchased if they're perhaps a food manufacturer and get purchased by a Nestle or some huge conglomerate if their product has viability. They might be purchased by some other investor. They might want to be bought after year 8 or 10 or 15 by another small business owner, or pass it on to a family member. If you're distributing out all the profits or a majority of the profits, it'll reduce the value of your business at the end of the day, at the end of the tenure that you want to run your small business for. The more cash you retain, the more equity you retain, the more value your business ends up having. So it's helpful not just in terms of, a lender needs to see this. It'll help that small business have longevity. You're more resilient to, again, unexpected things that might happen. You build up value on your business balance sheet. You have more assets. You have more recorded profit that increases your business valuation if you ever need to sell a business. So there's benefits not just in terms of, a lender wants to see this. There's benefits to the business owner as well.
Oh, David, first of all, thank you for taking this time to speak to us. But I think that last note really hit home for me, because it's one thing to do and to have certain practices because maybe one day I want a loan or one day I want to sell my business. It's another thing to do it because it benefits all of those things, right? And it benefits me as a business owner and my ability to manage my business, grow my business. And it sounds like having more planning and having this understanding of business distributions can really facilitate that and can really help our business owners. So I want to thank you for sharing your knowledge with me today. I'm sure I learned a lot, and I'm sure a lot of our audience members did as well.
I hope so. Thanks for chatting.